Good morning, this is Kim, and today I want to talk with you about both mutual funds and exchange traded funds. And I'm going to try to make this as simple as possible because you will have already done some pre-work before you get to this video. I'm going to show you by taking a look at both on this side with Vanguard, we're going to check out mutual funds, and on this side over here, we're going to look at exchange traded funds. The larger picture is that a fund includes multiple stocks or multiple bonds or both, as I'm going to show you right here. So I go to the Vanguard homepage and I'm going to look under investing and I'm going to click on Vanguard mutual funds. Next, right here on this page, I want to tap on the link that says Browse Vanguard funds by asset class. Oh, cool. I'm going to wait a second, and what we're going to see is a listing of all of the mutual funds offered by Vanguard. It's not so difficult. I want to tell you that they start in low risk to high risk order. So up here we have money market funds, which we already discussed. Money market funds are included at banks, if you remember from Safe Places for Money. As you can see over here, the federal money market fund doesn't really pay that much, 0.18%, 0.25%. These are the percents year to date. However, now at this point, they pay significantly more than our big banks here in California, Wells Fargo, Bank of America, Chase, those types of things. These are still paying higher rates. All right, now I'm moving down, and you'll see the next category are bond funds. So we've learned the underlying investments in a mutual fund. In other words, we've learned about cash, we've learned about bonds, and we've learned about stocks. So a mutual fund is just going to contain, instead of buying one stock, you would buy into a fund that has a whole bunch of either bonds or stocks in it. So let me give you an example. I'm going to click right here on a fund, on one of my standard funds. Oh, and by the way, when it says investment grade, that means it's graded or rated, and these are going to mostly be corporate bonds. But I want to take a look at this just intermediate term bond right here, investment grade. And what I want to show you is that in a snapshot, we can see that first of all, risk right here is 2. The reason it's not up here anymore is because it's a bond fund. And with bond funds, we have a certain amount of guaranteed interest, especially if it's a highly rated fund with a lot of A-rated bonds. The next thing I want to point out is that if I go up here to portfolio and management, instead of having just one bond in this fund, it actually has 2,154 bonds. So that overall reduces the risk because you may have some bonds in here that end up failing. Something happens with the company, or for whatever reason, profits are down, bankruptcy, whatever. But you have a whole bunch of other bonds that can make up for that difference. So in this one, again, 2,000 bonds and more. If you scroll down even more, you can see what type of bonds are in the fund. So if I look here, this fund has some U.S. government bonds, but not that much, 6.5%. And then it has a whole bunch of A-rated bonds. Now, the different variations of A's are just different types of companies, how the rating agencies work. So 12, almost 13% are AAA, and then again, A is A. That's my thought. There's a few B's, and again, some of those B bonds again are not as financially solid as an A bond, and then really nothing in the junk category at all, maybe one or two. So overall, it's a pretty risk averse bond fund across a lot of different companies and a lot of different industries. Um, That's what it is. So the reason we would buy this is because we're interested in bonds overall for safety. That fits our risk profile. And we want a fund because it's diverse. It is diverse. All right, I'm going to go back now and I want to show you a different type of fund. So now I'm going to scroll down from bonds, and I was just in investment grade, which are corporate. Below investment grade, this would be junk bonds, a bit more risky. If you wanted to tap on this, you would see that they're a bit more risky. And then we have the tax exempt category. These are all municipals, as we learned in class, offered by state, local government, any government below federal government. And now we have this category of funds called target date, but really the overarching category is balanced funds. Target retirement funds, balanced funds, will include a combination of stocks and bonds. So, for example, let's say you're 20 years old. 20 years old, you're not going to retire for another 40 years. And 40 years from now puts you at about 2055. So, in this target retirement 2055 fund, again, the year relates to the year when you might retire. We can click on this. And first of all, we're going to notice that look at the risk. It's gone up to a 4. And the reason it's gone up to a 4 is because it includes more stocks. So going back to that investment pyramid, higher risk, potential for higher reward. This fund is going to contain more stocks. Why? Because you're young. You're only 20 years old. You have a lot of time to weather the ups and downs of the market. I'm going to click over here on portfolio and management, and we can see right here 90% of this fund is stocks and only 10% of bonds. So that's what makes up most of that risk profile. Again, it's called balanced because it has both stocks and bonds. Back up one more time and tell you that after balanced funds, here we're going to go again increasing our risk. There's some target risk funds. Conservative, are you more into growth? Again, folks who are more conservative are very risk averse. They don't like risk. We have some other balanced funds, and then we have all 100% stock funds. These are going to be again in the 4 risk category, but typically overall the return on stocks over time versus bonds over time significantly favors stocks. So stocks have generally outperformed the bond market 4%, 5% over time. So that's something you want to keep in mind. And again, if you're young, you can you have the time. I mean, the market may go down, but you're dollar cost averaging into it and you can make some significant money. After we do stocks, then we do variations on stocks. So, for example, these are all large cap stock funds, and then you have mid cap, which are a bunch of medium sized companies, and small cap small companies. Now, why do we study all these mutual funds to begin with? Well, because I'll give you an example myself. So I work for the college and I have a retirement plan. And in my retirement plan, my options are only mutual funds. And that probably will be the case for any of you who go to work and you're offered a retirement plan through your work. The lineup or the investments you can pick are going to be mutual funds. So it's really important for you in your life. Mutual funds are the largest investment category of all, and you will be exposed to them typically through your work. So in a next video, I show you how to evaluate a mutual fund, and I want you to remember how to do this. It's not difficult. You'll be able to receive your retirement plan from work, take a look at that evaluation, and figure out, okay, which funds are best for me. In my situation, I'm not 20. In fact, I'm significantly older than 20, and yet I still have most of my money in the stock market because I'm not going to retire for a bit, but I'll be younger when I retire, and I want to enjoy the benefit of a growing stock market over the safety of a bond market for right now. Okay, I'm going to switch gears now, and I'm going to talk about exchange traded funds. And I'm going to do that by looking over here on TD Ameritrade's website. The reason I picked this website and I didn't use Vanguard is we need a little bit of variety, but also TD Ameritrade is another website that offers free, commission-free exchange traded funds. So if I go here under investment products and I select exchange traded funds, they have over 100 commission-free exchange traded funds. Now remember, ETFs are traded like stocks. In other words, you buy them, they're traded on an exchange. Mutual funds, on the other hand, you would buy directly from the mutual fund company or enroll in them through your retirement plan. They are not traded. Again, they are not traded. However, they both involve the same concept of buying into a fund that contains a diverse selection of stocks, bonds, or both. So I want to take a look here at the commission-free ETFs. See if this is the, and here they are. Commission-free means when you buy these, you don't pay a broker fee. When you sell them, you don't pay a broker fee. So all our money goes to work when we purchase these. TD Ameritrade has a lineup of commission-free. Schwab has a lineup of commission-free. Vanguard also has commission-free. And E-Trade has commission-free. In an exercise for my class last semester, we evaluated all of these different vendors to select the one that really had the best choices for us. And TD Ameritrade was pretty high up there, and Vanguard was second. Anyway, here I'm in the category called equity. Equity means stocks. There are 34 funds to pick from, and here they are. So the fund lineup includes, I'm going to go ahead and click on the Morningstar category so I can sort these. They have allocation funds. These are very similar to target retirement. Again, 30 to 50% stocks in this one. Another 30 to 50% stocks, 50 to 70 here, etc. And then they have all these categories of large stocks, large company stocks, followed by mid-cap stocks, and on the next page we'll see small cap stock funds and perhaps I think they'll probably end at that. Over here, if you look at these, you can see that they also, through TD Ameritrade, they also offer some Vanguard mutual funds. So you could have opened up an account at Vanguard or have one here at TD Ameritrade. The reason I like TD Ameritrade is because there's no minimum to open up an account, so you can actually open up an account, put 25 bucks in it, and then go over here and start selecting, maybe pick a great all-around exchange traded fund that you'd want to buy and start investing. So for example, if I look at these asset allocation funds, the price per share is $33. So if you're putting in $25 a month, it'll take 2 months and you can start buying into the stock market or buying into the bond market, or in this case buying into both because it's a balanced fund. Last semester I had a whole lot of students really interested in this Vanguard Mega Cap Growth Fund. One of my favorite funds right here of Vanguard is VIG, so I'm going to click on that one. So when I look here at VIG, the cost per share is $85, so that's how much it would cost for you to begin investing in the market beginning investing maybe for your future house or for your retirement or whatever your financial goals might be. In this particular fund, here's a chart from July, last July. So we had a really rocky last year, and here's where this fund is this year. And what we want to look for in a fund is how much does it cost us? I'm going to go over that next week. This is a very cheap fund, but fees are important. So again, I'll go over that next week. Let's see what's in this fund. Let's go look at the portfolio right here. And we will see that the top holdings in this fund represent these companies: Johnson & Johnson, Microsoft, Coke, Pepsi, Medtronic, McDonald's, CVS, 3M, UTC, and Walgreens. So that's what you would be buying. Those are just the top 10 holdings. There are probably a lot more companies in this fund, but I just want to give you an example of what's included. So again, when you buy a share of this, your $85 would mean partial ownership in all of these companies and more. So you've bought into diversity, and it's really important that you understand that. As a beginning investor, you might think you want to buy one stock, but putting all your eggs in one basket is just too much risk. So I try to really stress how important it is to be thinking about exchange traded funds and mutual funds. And in fact, over time, we have a lot of students who end up starting their first Roth IRA, which is next week's conversation, and or a week after, and they start buying exchange traded funds, or they maybe have enough money to walk through the door on a mutual fund. But either way, they do something, or they have a plan to do something. Because again, I don't know about you, maybe you're going to inherit $1 million, but for most of us, that's not going to happen. And then the next thing is we have to start accumulating money for the things we want in life. And maybe that's putting your kids through college, or maybe that's buying a house, or maybe that's going on an awesome vacation after graduation, or most importantly, it's saving for your retirement. Because when you retire, Social Security is not enough. It doesn't even come close. So it's going to be up to us to put all these programs in place so that we're securing our financial future. Again, when you work for a company, you always want to ask, do I have a retirement fund option? If you do, great. Can I receive the information so I can take a look at the mutual fund offerings? If you don't have a company sponsored plan, know that you can open up a Roth IRA and you can start self-investing in an exchange traded fund or two. You just need to pick the vendor you want: E-Trade, Schwab, TD Ameritrade, Vanguard, maybe even Fidelity, although Fidelity is expensive to get through the door. And we need to start investing. So I just want to show you here that these are the two types of investment vehicles for you. This is your playground. This is where you go. This is where I go to. This is where my clients go. My clients, some of them have individual stocks. Most of them are in a whole bunch of mutual funds and ETFs. I like both. So let's start with that and see where we can go with this next week. Take our time, and I hope you have a great weekend.